Highlight of the session, 18s. They ring a bell if you were in the room throughout the session. Simply looking at rotations to a certain level. This is a 24 PNF, so it's more like an hourly chart. So the market at like 1 o'clock in the morning came into it and then broke back lower. Actually, it's these two in here. About 1:30 this morning, the market comes up to the 18 area, stops, and rotates down pretty significantly, right? Does it again about 6 o'clock in the morning, Central Time, comes down pretty significantly. So what you have here is when we opened up in this area this morning at 8:30 Central, you have a situation where, yeah, it gets down to 84, and you're going to scare a lot of longs and push this market to the downside. But then through 18, we'll rotate a little bit underneath it and then look out above. Now, I don't know it's going to go to 63, 64, which so far it's gone a couple hours later. But you do know that a breakout is possible once you identify the box and congestion, especially when there's volatility and actual decent volume. So when you go through 18 like that, you just don't want to be stuck short. Here's the reason why this happens. This is not just something, okay, goes once, twice, third time, buy it through it. You got to understand the why this happens. One of them is people see it work once, they see it work maybe twice. So everyone's trying to sell it the third time because it's confirmed resistance. There's no such thing. You don't want resistance confirmed unless you were in and out of it for a winner. Because once it's confirmed and once it's obvious to most of the rest of the world, guess what they're trying to do? Get short. And if everybody's trying to get short there, everybody turns into a buyer. And that's what helps push the market up. Because after you sell it, you're a buyer. After you sell it to get short, you are a buyer to get out of that short. You hope to buy it lower, but you're still a buyer. In fact, every time you get short, I guarantee you, most of you put in a buy stop to get out for that loser. And then a buy limit, probably connect it with an OCO, a buy limit below if the market's here, and a buy stop above if you're short. You think it's going to go lower, that's why you got short. But if it doesn't, that's where your risk is. So the point is, you are a buyer after you open a short position, and if you get a lot of people get short at what's considered an obvious price, it might work sometimes. You just don't want to be with the herd. So that's how you understand the why when there's an obvious swing high or low, that not to play it with the herd, even if it works. Same thing down here. If we would have went down there, would have rotated down and then shot lower. It's really important to understand congestion boxes on different time frames. But if you don't understand why it would work or why it doesn't work and create a disqualification/qualification process, then you're not going to understand it in real time. And that's what's most important. Real time information. Have a safe rest of the session.